Hello everyone, my name is Leda Glyptis. Welcome to Fintech Insider On Air episode 30. Thank you so much for tuning in last week, well, to those of you who tuned in last week. We had a bunch of people live and even more watching afterwards, so thank you for all of your support. We have quite a lot of amazing numbers to live up to. So last week, David was in a pub with Jason talking about what digital really is. It was a really great episode, so go check it out on his Periscope and the 11FS YouTube. This week, we are not in a pub, as you can see. We're in the office, so I feel robbed. But we are going to have a conversation that is even more interesting. I am here. I know.
You know, okay.
I am here with the wonderful Ronit Ghose, who's Global Head of Banks Research at Citi, and we will talk about the future of banking. Thank you so much for being here. Ronit has actually interrupted his holiday to be here with us today.
I have. I put a proper shirt on as well. I don't know why I did that, given it's where we are. But
well, exactly. Well, we feel honoured that you took time out of your holiday to be with us, and apologies to your family for.
Oh, they're watching.
Things.
Hello.
Oh, hi. This is going to bring our numbers up, right?
It's gonna. There's all three of my boys are watching. Probably not the older one, but
Oh, that's fantastic.
My 5-year-old's watching it. Sure.
Saying, "Go, Dad, you're amazing."
Yeah, he'll be googling it, later on.
He'll
to
have
get your
questions.
Stats up. He'll be, yeah.
I bet you he's going to ask you some of the most challenging questions of the day.
Totally.
So let's start this interlude to your holiday with some numbers. While digitalization can lower costs by 30 to 50%, new competition and greater transparency are likely to lower revenues by 10 to 30%, a sobering number. An average bank has 20,000 to 40,000 people working in operations and technology, which is where I started my career, if anyone's interested. And it can account for more than 50% of the workforce. How does that add up in a way that doesn't leave us thinking about people losing their jobs, which is the first thing you would think of looking at those numbers?
Sure. It's actually an interesting question when you think about, you sort of go back and think about technology and job creation, whether it's in banking or other industries. Now, neither of us are old enough. Well, a bit older than the people in this office, but neither of us are old enough to remember the ATM, right? Do you remember the ATM later? When was the first ATM? When was the first ATM?
It was before I started work.
Before you started work. I think it was before we were born. So there's a bit of a fight. In the UK, I think Barclays claims they were the first, 1967. And in the US, there are a couple of big US banks that say they were kind of around the same time. Moon landing, ATM, it's kind of the same time. We'll come back to moon landing.
I like how you worked that one in.
I did, yeah, we'll come back to moon landing. But the ATM, so when the ATM came about, a lot of people said, oh, what's going to happen to the branch teller?
Yeah.
There's going to be a big reduction in jobs. And actually, the number of people working in banking carried on going up. So it's not like one-for-one correlation. New technology comes, people lose their jobs. What will happen, we imagine this time around, will be as new technology continues to pervade banking, from whether, we had 10 years of the smartphone, cloud computing, et cetera, nature of jobs will change. There'll be fewer jobs inside the organization of big banks, and there'll be more jobs in organizations like this or affiliates or service providers, and there'll be lots of new jobs being created outside banking. There'll be, whether it's in design or software, lots of new jobs being created.
It's both a very positive view and a very realistic view, given how the market is going. And although, I don't know if I've told you this before, but the ATM remains my favorite banking innovation, which I don't know if it goes with my age or how I behave, but it is my favorite because it's so transformative. But as you say, it was transformative for the lives of the consumers. It didn't transform the bank as much. We're now looking at technology that is transforming both. And to go back to the point you made, banks might see reduction in the jobs internally, but that doesn't mean that the jobs overall will be reduced. But let's stay with I totally agree with that, by the way, I'm not going to challenge that. But let's stay with banks, because one of the things that we can say about all the organizations we've worked in the past and the ones we interact with is that banks aren't lean. Historically, their staff base has been possible to be big because the cost per unit wasn't forbidding. But also, before the technology we have today, you needed humans to do things. I have looked at solutions in the past that would say replace a 700-person reconciliation team with an API. That's not an easy thing to reconcile internally. But we know that since the financial crash and revenue growth being what it is, compliance costs have gone up,
Absolutely.
competition costs have gone up, and these humans are still there.
Yeah.
And when you think about them as humans, that's a hard thing to wrap yourself around. But
Very
if you
much
think
so,
about
yeah.
the cost
Yeah.
and the value created,
Yeah.
it's a challenge.
Yeah, and what's happened in the last 10 years, and let's sort of focus on the US and the UK, or US and Europe, because what's happening in Asia or Africa or Latin America is kind of different. So if you focus on Europe and the US, headcounts come down already. In fact, if you strip out what you call compliance, central functions, the whole FCC, financial crime, compliance functions, front office headcount is often down, 20, 30% or more. Think about capital markets industry that I'm part of, and I think you were once involved in many.
In my banking days.
Exactly, in your banking days. And so when I first went on the Salomon Brothers trading floor, many years ago.
I remember them.
You remember Salomon Brothers? When I went to the trading floor, the whole floor was full of cash traders, people trading equities and bonds, cash. We probably had 3, 4, 5 people trading financial equities alone.
Yeah.
Today we'll have like a couple of people, if that. There's already been a significant reduction in parts of the industry.
Yeah, you're
which
right.
have been
Anyone
automated.
working at Deutsche Bank will be nodding. Should I say,
unfortunately,
anyone recently working
Yeah.
at Deutsche Bank will be
So-
nodding sagely right now.
There's been a big reduction in headcount. In fact, if you look at the whole European banking industry, kind of peaked in 2007, not surprisingly, financial crisis in 2008. From 2008 to 2017, headcount's down for the banks we track about 16%. But if I actually stripped out the compliance and the FCC and all the central functions, sales and front office headcount's probably down anywhere between like 20, 30%.
These are sobering numbers, and although I don't want to ever lose sight of the fact that these are humans whose lives are disrupted, and there is a bigger conversation maybe for the next time we do an on-air about how banks can support the reskilling and upskilling of all of these people. The reality is that with the technology we have now, you don't need as many people doing the work. So
Agreed.
the transition is always painful for some, but let's look at the upside from a consumer perspective,
Sure.
but also at the challenges from a business perspective. Because as the staff are going down, it's not necessarily the most expensive staff that are going down, and the pressures on the bank from a revenue perspective are still there. How are you seeing in the work you do in the banks and the markets you track, how are you seeing the revenue growth and the cost pressures, not just on the human side, balancing?
Yeah. So if you strip it back to, we'll come back to talking about consumers and the clients, which are always the important people in a second. But if you think first with the investors and the board, and from a financial perspective, there's a big challenge, particularly in Europe. Less so if you're sitting in Singapore or Hong Kong. They have their own challenges, and you can talk about virtual banks and new entrants and TechFin and so on. But the biggest challenges in Europe is there's a structural profitability problem, and it's really continental Europe more so than Scandinavia. And the problem is return. As analysts and investors, we talk about return on equity. How do you measure financial returns? In the US, banks typically make mid-teens ROEs. In Europe, they make high single digits if they're lucky, most of them. So the average in the industry is about 8%. Now, cost of capital for these banks in the public markets typically would be pegged at 10, maybe 9. It would be a higher number than their profitability. So if you're an investor, you look at the sector and you go, I really want to invest in this sector. And so if you're a CEO and you're telling your board, well, we're going to improve our profitability, how do you do that when you've got all this burden of compliance and AML and regulatory and legal stuff that you have to do to stay in business? You're looking for cost savings. And then it's about how do we do this cleverly and smartly. So some banks have done this quite well. So a region that really stands out in Europe is sort of Northern Europe, so the Benelux, so the Belgians, the Dutch, and Scandinavia. Despite very low interest rates, they make decent returns. They make double-digit returns. But then you've got the bulk of continental Europe that are still kind of staggering, stumbling with low single-digit financial returns. So these banks typically have 80,000 people, 100,000 people. in some are even bigger if they have international operations, over 100,000 people. You've got to change the shape of these banks. So you can't really, for now, for political reasons, touch compliance and legal.
No, you can't.
So, at some stage, maybe we can, have smarter ways of doing RegTech. But for now, what you do is you have to, think about how do you improve the front office productivity and the middle office.
And this is fascinating, and I could actually listen to you describe this for a very long time because it's highly accessible. So thank you for that. We can't shy away from the realities of what you're describing. If it's unattractive for investors, but growth is stymied by the fact that the cost base won't go down, be it because your compliance costs are high, because you essentially have a business to run and fund, even if you cut some of the overheads, it's still there and burdening you. If your revenue is squashed, your costs are baked into a very large extent, and your biggest carrier of that compliance you can't do anything about. You have something's got to give, and for those who are fighting to survive and grow in this environment, some bold decisions need to be made. And there are several aspects to that. I guess one part is, have you seen any such moves from your perspective as an analyst with a bird's eye view of those markets, saying, you know what, that is both brave and actually clever?
So there's kind of a couple of ways to do this. One is you could say, right, I'm going to sort of set up a new bank here. I'm going to have my old bank here, and
like
I'm going to have
captive.
I'm going to have like this kind of challenger bank, my own challenger bank, an experiment. And obviously you've seen now in March, April, May in Hong Kong with all these new banking licenses being given. You've got 8 of them I think that have been given out. So some of the banks I know well have chosen to take these licenses. Some have said no, we don't want them. So that's one way to do it. Set up a new bank, and here you get a chance to say, I'm going to start with a blank piece of paper. I don't have all this,
the baggage. But
I don't have the baggage.
How blank is the sheet of paper? Because the reality is, without referencing any examples in any geography, the realities are that if you are a fully owned subsidiary operating under the name, and if not the name, under the wider roof of the bigger bank, quite a lot of the policies, procedures, and approvals processes creep back in. So, is your technology all yours? Sometimes yes, sometimes no. Is your decision-making structure different? Sometimes yes. How much are you seeing that this freedom is actually true?
Those are totally good questions. Totally relevant questions. So the first thing is, let's start with the technology. There are examples, and I'm not going to shame them, but there are examples in Europe where banks will say, I've got my own challenger bank, and you ask them, what does it run on? Oh, the same mainframe I had.
80-year-old,
Well, maybe 50 years old, maybe late 50s, early 60s mainframe that my big bank runs on. But what was interesting about, again, without naming names, but the ones in Hong Kong, the ones I know about are actually going out and building themselves on new technology. And actually, some of them seem to be trying to build a new generation technology. So not just saying, I'm going to go to Temenos rather than IBM. They're saying, I'm going to go to the next generation and see whether, a sort of a new generation software provider that I wouldn't want to run necessarily on my whole bank. So I'm going to try it out on my new bank. If it works, maybe I scale it up. So I think there are some examples, and we're seeing them in the UK as well, of banks setting up challenger banks with new technology. The harder one is the rest of what you said, policies, people, culture, processes, because that challenger bank you're setting up will still have the name, or it'll say ABC New Challenger Bank backed
You're
by...
still under my roof.
Exactly, and that's really hard from a reputational and a regulatory perspective. How do you
but
square
also
that circle?
habits. I will never
and
forget.
if you downstream all the people from the big bank, it's not going to work.
I'll never forget. I once had in a bank I once worked at. People can work it out for themselves.
Would have been 2, right?
3 actually.
Oh, 3.
Yeah.
There was that.
Yeah,
that German one.
You can actually. There's that German one.
That German one.
So in one of those 3, I once had the same meeting with 6 legal teams. Different legal teams. After the thing had gone live.
Right. Did you have meetings before it went live?
Yes,
okay,
with
good.
different legal teams, because there was an abundance of legal teams.
Okay.
But it was both surreal and part of a particular type of process that you can't get away from.
Sure.
And although most of the time it worked much more logically, it does mess with your ability to have agility. That rhymed.
Yeah. Yeah.
But here's a difficult question.
Yeah.
Can you hold on to that thought? Or should
I'm going to hold on to that thought. It is related to what you're saying. But I'll hold on
very
to it.
difficult question before I choke.
Yeah.
Do you believe, and you can give me a vague answer so that you can be right, whatever you say, but do you believe...
We never do that as analysts. Never.
Of course not.
Never.
Do you believe that these challengers that are owned or bankrolled by the big players are genuine seeding for the future or diversification exercises? And they're valid and meaningful either way. But from a strategy perspective, are you seeing more of one or more of the other? Or is it actually difficult to call it?
When you look at it from the point of view of the broader market, so the industry, so not the bank itself, but the broader industry, the most revolutionary or disruptive we've seen, whether it's for clients or for the industry, aren't the bank-owned challenger banks. Yeah. There's maybe one or two that are kind of interesting in terms of from the bank perspective, like without giving Goldman a plug here, but Marcus does take Goldman Sachs into consumer. That's a kind of strategic innovation.
There's a fan base for Marcus in the office behind you
that
you can't believe.
So I don't know if they're doing that much, exciting stuff on the tech front. I mean, it's not even available on the app, is it?
I know.
I mean, that's so American. I mean, how can you not have an app? But the biggest, so that's kind of interesting. But the biggest, most interesting. Though, go on. I was going to talk about TechFin, but
I think it's a in your face from Goldman Sachs that actually people are more interested in the rates than they are in the app.
No, it's the price. It's a price point, right? Yeah. But then to some extent, FX retail.
Yes.
A couple of famous ones in London. I mean, that was a price point. It grew in London because UK retail banks charged a lot for FX retail, and there's a lot of us in London that travel abroad, have family abroad. But getting back to your original question, I think the most interesting or disruptive so far hasn't been the challenger banks or anything the banks have done. It's been the tech fins. Yeah. I mean, if you look at, and it's a bit of a cliche now, but what's happened in China or in Kenya or is emerging in Bangladesh with the telcos and some of the mobile money plays in those countries, that's game changing. Yes. That's like, if you, anyone who comes back from China goes, oh, I can't use cash anymore, right? Well, that was the last time we had a kind of game-changing thing, without going back to the 1960s, and neither of us were alive, but that was the last time the UK or US consumer had a game changer in that way. It was really the ATM because, before the ATM, the bank shut and something,
and then you had no money.
At 3 o'clock in the afternoon or something absurd, right? The bank is shut and then you're stuck. So with the ATM, the bank is literally open all 24 hours, 24/7. Yeah. So that was and the credit card. So 1950 through, depending on how you date it, it's kind of starts late 40s, 50 through 1960. The credit card emerges. So in the UK and the US, the sort of revolutionary form factors from a consumer perspective are like back in the 50s and 60s. But okay, then there's mobile phone banking, First Direct.
You're feeding the fact that I still think the ATM is the most exciting thing. You're not proving me wrong here.
No, but actually there's a central bank governor, a US Fed governor, who's maybe as a joke said, the last good innovation in banking was the ATM, right? But
I wouldn't take it that far. No, it's still my favorite.
But if you go back to sort of what's happened in China in the last 10 years, or Kenya, what's now happening in Bangladesh, Pakistan, you're bringing financial services to a vast, millions, hundreds of millions of people with new form factors, new technology, processing abilities that Ali and Tencent have that are of a different magnitude to some of the banks that we're familiar with. And that's been the big game changer. The stuff that we all talk about, particularly in London, in the London bubble, in the fintech bubble, I mean, there's some really cool companies and they're doing really well and their funding rounds, they're getting higher valuations and that's all fab, but it's still foothill stuff.
I agree with that, and I'm glad you brought it up because it allows me to ask my favorite question. Because I am a big believer the valuations are great for the teams, but actually it's misleading as to what it does for the market and the consumers. Yeah. Well, no, it's not misleading what it does to the market, but for the consumer it actually can be. Although, if you are at the receiving end of that valuation, you're dancing, right? Yeah. But you pointed out, if I can pick on what you said earlier, you pointed out the fact that what we're seeing inside financial services, so fintech inside the world, be it our bubble or the mature markets, is not too different to how the rest of banking has emerged over the last few hundred years, it's benign opportunism, and I don't say opportunism as a negative thing. You see an opportunity, you go for it.
Yeah.
That is how modern banking has emerged.
Yeah.
I am down with that, and that's what a lot of fintechs are doing. They're seeing an opportunity to provide a service better, cheaper, faster, whatever.
Yeah.
But to your very valid point, what is transformational is those companies that are coming in using digital capabilities to completely reimagine human experience. Because fundamentally, digital transformation is not about the tech, it's not about the ops, it's not about the support functions. I mean, it's all about that, but it is about how we live.
Yeah.
So you have those really transformational things coming outside the industry. Not surprising, usually big change comes from a different vantage point. Do you feel that some of the regulatory pushes we're seeing in Europe, open banking, but not only, because I really do think that there is definitely a direction of travel that the European regulator is spearheading. Do you think we might see some of that activity either come to Europe or flourish in Europe, because there is essentially an invitation? We've seen a lot of activity, but not that. And it seems that the regulator is going, more please.
Yeah, yeah. Regulator, so big picture, regulator is super important for the whole kind of, this whole narrative, this whole story. And so, I sort of don't want to be flippant about the London bubble, but there are lots of new companies, lots of new banks that have been set up in London and the UK. There's some outside London as well in the UK. You haven't seen that in the US until recently. In fact, or a few in continental Europe. But there's a reason why we have so many new banks. It feels like every second person we know in finance is either setting up a new bank or advising a new bank or doing something with a new bank.
Oh, if you put advisors in there, that would almost be everyone, right?
Yeah? I mean, I was thinking, like, when was the last time when there's so many new banks? It's almost like Dickensian, about the 1830s or 1850s.
Yes, or
sort of
London
is like
Pony Express era.
Exactly.
Sort of pioneering America.
Now we've gone to the US and American Express and Western Union. But yeah, it's like, it hasn't. So there's a lot of and a lot of this happening. There's two big reasons why it's happening. Obviously, there's the tech. There's the whole technology revolution. But the two big reasons it's happening is availability of capital, interest rates being low, and the regulator. The regulator in the UK sort of reacted to the global financial crisis and said, had a lot of big banks, got us in trouble. Let's go for competition. And this fintech revolution. This fintech thing, perfect.
Yeah.
And it's not easy, as my friends who've set up banks will tell me, or advised banks will tell me. It's not easy setting up a bank, but it's possible. It's doable.
Yeah. And it's undeniable that it has happened where the regulator has permitted and invited it, and it hasn't happened where the regulator hasn't.
Exactly. So it's really hard in the US to set up you often run, these new banks will run on the rails of existing banks. And that's kind of interesting. The same happening in Hong Kong, it might be happening in Singapore and Taiwan. The regulator's pushing. And so that same way the European regulator in the EU with open banking and specifically PSD2 in the EU, sure, it's great, it's positive, it's helpful. It allows us to maybe reimagine client interfaces and how we do banking, but I'm not convinced it's as revolutionary, anywhere close to revolutionary as what we've seen in Asia or Africa. Lives have been changed.
We forget that, don't we?
Lives have, like M-Pesa didn't replace a bank or didn't compete with a bank. M-Pesa basically substituted the bus driver taking cash back to the family village. Someone would have given their friend or the driver, here's some money, please take it back to my family. That's what it replaced.
And the speed and the safety.
And then you're doing it on the phone, and like literally every family in Kenya now has that as an.
And that's an exercise in imagination as well as everything else.
Kind of imagination, but also it's like stuff happens. I mean, when Safaricom or Vodafone set out to do M-Pesa, they didn't have 100% exact idea it was going to work out.
Yeah.
Like it just kind of, they thought, look, a lot of people have phones, not many people have bank accounts. Let's see what we can do.
Let's see what we can marry
and
there. But can I take you back to the regulator for a second, just because it's my favorite topic at the moment.
Okay.
And I haven't spent enough time on this to be able to substantiate it. But looking at the landscape, after quite a few years of this space, whatever we want to call it, growing, maturing, evolving, and the regulators taking slightly different stances on certain issues. To your point, around what the solution to the crisis might be. From the outside in, it looks like the business models that will even be attempted, let alone succeed, the types of partnerships, the types of sizes of organizations, and the type of technology you will therefore get, and the type of business ideas you might get are to a certain extent predetermined by the regulator. And there might be some choices made.
What do you mean?
So there might be some choices made that are obviously dictated. So in Hong Kong, in Singapore, we're seeing that the regulator is allowing new players to come in, but they need to be backed by an established player. Whereas in the UK, that was not the case. The capital requirements were
but
considerable.
But not quite the Hong Kong levels.
But there was a conscious choice that new entrants should come in.
New people could come in.
Exactly. And these are conscious choices. But there are also some lateral choices, some implicit choices made. But if you look at the landscapes that you described, it's either active regulation or the absence of constraint that makes certain things possible. And if you want to boil it down to the single most determinant factor, there are days when I say, well, actually, the regulator determines what type of business model is viable. And what we're seeing a lot of, particularly in the fintech space, but actually more widely, is that people who have a particular idea will now go to the place where the regulator is more likely to make that a good thing. You have a much more holistic view of the market and you spend more time looking at it. Does that sound entirely stupid? It's okay if you say yes, I'll still love you.
But I think at root what you're getting to is the difference between banking and financial services and other products that have been digitized. So the conversations we were having 3 or 5 years ago were along the lines of, hey, look what happened to media. Look how digital changed media, or look, advertising, or all these other industries. Like finance is an intangible industry, right? It's not like I'm making a car. It's an intangible.
What do you do all day? What do you say to your mother when she asks?
She worked in a bank too many years.
Well, maybe you can give me some answers for mine.
How do you explain it to your 5-year-old, right? It's easy. You get money from the bank. That's
what I do.
That's what you do.
I make money.
You go to the bank, you get money out. That's how it works. So, it's an intangible industry, like all these other intangible industries that have been heavily disrupted by digitization and technology. The big difference is the regulator. To be in most financial services, you need a license to operate. And so I think that's where you're getting to is regulators can, allow, like we've seen in the UK, enable fintechs to grow, or they can restrain it, constrain it, kill it. If you look at sort of developments in non-banks going into financial services, I used the Kenya example. For many years in Nigeria and Egypt, very large countries, similar level of underbanking as in Kenya. It was very hard for telcos to go into mobile money, go into banking. Why? Because the regulators made it harder. Now that's changing.
Yes.
Now, what we're seeing in many countries around the world is actually, at least at a very high level, at a policy level, at a kind of strategic level, is almost a kind of arms race of who can be more fintechy. It's like, how many fintech festivals are there? How many fintech hubs are there, or ecosystems, right? I don't know how many invites you get. Literally, there's 200 countries in the world, I think. I'm losing track of how many fintech hubs there are. They haven't got one. They're about to set it up.
Oh, absolutely. I lived
probably
in a...
calling 11FS for advice, or someone like you to help set
I lived
it up.
in a very small country recently, as I'm sure you know, and there were almost as many fintech initiatives as there were people in the country after a certain time. And I'm a little cynical about all the sort of lateral activity that happens in the space. But at the same time, I do think that the more people spend time talking to each other and thinking and creating within the boundaries of what is permitted, you get a lot of very cool stuff. And one of the interesting things about, coming back to your possibilities around open banking, is the maybe the possibility that the sort of services layer of an offering that might become almost a new vertical. A lot of companies, a lot of fintechs are increasingly in the last couple of years seeking to home in on that.
Yeah,
and of
the
course,
client interface.
the client interface and
Yeah.
not so much riding on the rails of a big bank as in the US, but sitting on top of the offering, the license.
Yeah.
The specters of disintermediation obviously are re-emerging from a big bank perspective.
Yeah.
My favorite topic of plumbing is becoming ever present.
You can make money in plumbing.
I'm a big fan of plumbing.
Plumbers make money.
Big fan.
This is kind of, not all banks have to do the client interface. Yeah, some banks will be very successful doing the plumbing at a global level.
But it brings us back to the conversation we were having right at the beginning about how it's sad for some individuals, but banks now need fewer people.
Yeah.
If we go down this path of TechFin stepping in and reimagining the world and transformational activity happening while banks are shrinking down, but with open banking, financial services layer becoming almost a new market, do we need fewer banks?
You could have fewer banks that are client interfaces because you could get sort of a homogenization, a few platform companies that become the interface. Now that could be a bank. Banks have not been very good traditionally at going into adjacent products.
I don't know why you say that.
No idea, but hey, you never know. Could happen. But if you get a platformication of finance, is that a word? Platformication.
It is now.
It is now. Platformification of finance. That's going to be an Alibaba, right, or an Amazon, or a Google. Maybe it's one of the big banks as well. It's possible. So there'll be, most if you look at banking systems or banking markets, you typically get 4 or 5 banks, big ones.
The big ones, yeah.
So it's not like, there are hundreds of banks in the US or the UK, but when you look at a US market, like say New York or LA, 3 or 4 big banks that dominate that market. So at that level, it's already quite concentrated.
That's right. But if you go down, my favorite thing, plumbing. I spent time in the custody space, as you know. Scale is a strength. I love plumbing. You spend time in a custody bank, you love plumbing.
Yeah, right? We have a lot of that as well in Citi.
But one of the things you realize is that scale is not just a strength, it's actually part of how you deliver value. And the reality once you're in that infrastructure space is that it's not about how many each country and each market needs, how many the world needs. You don't need that many. You need enough to have competition and keep people on their toes. Always. Competition is good. But the reality is the world doesn't need that many custodians. So if we go down this path of, to your very valid point, not every bank needs to be client-facing, where does that leave the sheer numbers of banks?
Not every bank needs to be consumer client-facing, right? Because the platform can become your client as a bank. And you could have, this could be a way to re-globalize banks. Banks have really kind of spent the last decade de-globalizing.
Yeah. Again, cost drivers.
Yeah, because after the global financial crisis, consumer banking and SME banking began to make less and less sense for big global banks to do. So they began to withdraw to a small number of markets, their core markets. They probably did capital markets and wholesale banking globally, but it's a big withdrawal. But actually, the changing in the industry structure, see the new platform companies coming in, you could be a provider of back-end services to platforms all over the world. If you're like, not mentioning names, but you could. I don't know. This could be a way to re-globalize the. But of course, only a few banks will do that. Then you've got to have something neat or interesting in terms of product provision. Now, getting back to sort of the country level, for up to now, most banking markets in retail have been either local, like one state in the US, or even one metro area, or they've been national as in much of Europe. And so national brands, banking brands have still kept some value. Not in terms of love, I love my bank, but in terms of, I trust them. Now, that goes back to the regulatory point, which is, they're regulated. So if I'm really interested in finance or I'm really interested in technology that's different, then I'm happy to, put my money into crypto or go and find my whatever it is, But for 90% of the population, that stamp of approval with whether it's the FDIC or the European, different European countries, they all have their own banking insurance, 100,000 euros and 85,000 pounds in the UK. That's quite comforting that someone else is
That's absolutely
Someone else
right.
put a stamp on my bank. And that kind of creates a level of sort of trust. I don't know if trust is the right word, but
Well, trust is as right a word as any, and I think it captures how a lot of people, both on the consumer side, but also on the banking side, are thinking about it. But to bring, as we're coming to a close, to bring everything together, to your earlier point about the really transformative pieces coming from giants laterally moving into our space.
It's people going adjacent into banking.
Which is a very valid point, both in terms of how we see innovation coming in general and how we've seen disruption come in Asia and Africa. If we look at Europe, our sort of home turf, do you think it's more likely that one of the very big players out of China or elsewhere will expand, or do you think we stand a chance of creating our own?
It's a kind of maybe a longer conversation to be had about whether the Alibabas of the world, the scale and the sort of amazing transformation they've created in China that can be replicated around the world, is that intrinsic to the company, or is it because of the environment of China, behind the great digital wall of China? I could be wrong, but I'd be highly, highly surprised if these big Asian Chinese companies became large in Europe. Tying into your earlier question on sort of PSD2 and open banking, what'll be interesting to see is if the global or the American tech firms, and I can see what happens with Facebook and Libra, but will the American, the global tech firms say, hey, I can use PSD2 and become the platform. And I don't need the whole balance sheet stuff. I can could be a UK bank, it could be a Japanese bank to provide the balance sheets. I mean, Amazon here, if you get credit from Amazon in the UK, it's a Japanese company. Last time I checked, could have changed, but last time I checked, it was a Japanese non-bank financial company that provides the balance sheet. Most people taking the credit on Amazon probably have no idea. Right?
And don't care.
They don't care. They're just paying with Amazon, or they're paying later with Amazon. Amazon's the client. For the client, Amazon is the service provider.
And where the trust lives.
Exactly. And so that's the opportunity. And I think that'll grow over time.
That's fascinating. Ronit, I could talk to you forever and disrupt your family's holiday even more, but sadly, this is all we have time for this week.
Okay.
Where can people find out more about you?
You can Google me, you can look me up. All my reports are available online.
And we will be disseminating some of the links, because all the stuff you've been talking to us about, obviously, people can go and read themselves.
Absolutely.
Shameless.
Plug. So you just have to Google my name, so Ronit Ghose, and then if you put in Bank X or Bank of the Future, should pop up. If you're
you should definitely go for that one, because Foundry might be mentioned in it.
Foundry might be mentioned in the Bank X one. You might be in Bank X. I don't think you were in Bank of the Future, but that was last year. I didn't know you then.
We didn't exist then, it's
fine. So yeah, just Google my name, look it up, or you can look me up on LinkedIn, or you can look me on Twitter.
Fantastic. And you can find me at Leda Glyptis. Thank you so much for tuning in. If you want more insights like this, why not listen to our Fintech Insider podcast? It's available on all your favorite podcast providers. And if you want a topic discussed on air, hit us up on those emails or just tweet at Fintech Insiders. See you next week. Bye for now.
Goodbye.